Hi everyone, today we'll be going over accounts, February-March 2020, paper 3-2, question number 6. This is structure paper 3, which consists of 6 questions, each of 25 marks, and we are also given a time limit of 3 hours, so we will be attempting to solve each question under 30 minutes. And this question number 6 is a part of section B, which deals with cost and management accounting. Now, without any further delay, let's get started. The directors of W Limited plan to buy a machine costing 480,000 from an overseas manufacturer. The machine has an estimated useful life of 4 years with no residual value. Okay, then we are also given the estimated receipts and payments for the 4 years, and we're told that the cost of capital of W Limited is 10%, and we are given the discounted factors for the interest rate of 7% as well as 10%. Now, for the first part of this question, we need to calculate the payback period in months. So payback period does not incorporates the interest factor, which means that we can completely ignore the discount factor for this case. So we just need to figure out the net receipts for the each years 1, 2, 3, and 4 by subtracting our payments from receipts and then figuring out the total for each of these years. And the payback period is the time when our initial investment is returned, right? And we can see that our initial investment is of 480,000. Okay, so the first thing that I will be doing is to copy down the receipts and payments. Let's write it down. Let's copy down the amounts for receipts and payments. We can see that for receipts, that's 260,000, 290,000, 330,000, and 130,000. Let's write it down. That's 260,000, 290,000, 330,000, and 130,000. Now for payments, we can see that that's 90,000, 120,000, 140,000, and 80,000. Let's write it down. Okay, now in order to figure out the net, we just need to subtract the payments from receipts. And for year 1, that's 260,000 minus 90,000, which results in 170,000. For year 2, that's 290,000 minus 120,000, which results in a value of 170,000. For year 3, that's 330,000 minus 140,000, which results in 190,000. And for year 4, that's 130,000 minus 80,000, which results in 50,000. Okay, now for total, we just add our net for the years 1, 2, 3, and 4. For year 1, that's only going to be 170,000. For year 2, that's 170,000 and 170,000, which results in 340,000. And for 3 years, that's 170,000 plus 170,000 plus 190,000, which results in 530,000. And for all 4 years, that's 170,000 plus 170,000 plus 190,000 plus 50,000, which results in 580,000. And we just need to figure out the time when our initial investment of 480,000 will be returned, right? So these are the actual returns. And we can see that in year 1, we only have 170,000 back. In year 2, we have 340,000 back, and in year 3 we have 530,000 back, and the amount that we require is 480,000, which is obviously in between these two values, right? Which means that our payback period time is also between the year 2 and 3. So we can conclude that our payback period is going to be 2 years and some months. So now we need to figure out those months. So we already know that it's going to be 2 years. Now we just need to figure out the number of months. And we know that the amount that we actually require is 480,000, which is somewhere between these two values. So the difference between 480,000 and this amount of 340,000 is the value that we get within those months, right? So let's figure it out. That's minus 340,000, which results in the value of 140,000. So what this means is that we require 140,000 as our receipts in year 3, and we can see that the total receipts is actually 190,000, right? So we only require 140,000 out of 190,000. So our number of months is just going to be 140,000 divided by 190,000. And this gives our value in years, but we require it in months, right? So I'm just going to multiply it by 12, right? Because 1 year consists of 12 months. So this gives us our payback period to be 2 years, and 140,000 divided by 190,000 times 12, which results in 8.84 months. Okay, this is our required payback period. And we can round it off as well. So that could be 2 years and 9 months. Okay, now for the next part, we need to figure out our net present value. And whenever we are talking about net present value, it obviously involves our discounting factor, right? And the rate at which the discounting factor should be used is our cost of capital. And we can see that the cost of capital is 10%, right? So we will be using the discount factor for 10% in order to figure out our net present value. And in order to figure it out, we just need to multiply our net receipts with these discount factors and figure out its total. We already have our net receipts right here, right? So I'm just going to copy this column. That's yours. And the net receipts are 170,000, 170,000, 190,000, and 50,000 respectively for the 4 years. So that's 170, 170, 190, and 50. And year 0 is the time at which we make our investment. And investment is definitely a cash out, right? So our invested amount will be of negative value, which is 480,000. Now we just need to multiply it with the discount factor at the rate of 10%. Let's copy it. That's 0.909, 0.826, 0.751, and 0.683 for the 4 years. 0.909, 0.826, 0.751, and 0.683. And for year 0, the discount factor will always be 1 no matter the rate. Because discount factor essentially means that if we're talking about year 1, we are discounting this amount to the year of 0. But if we're talking about year 0, we need to discount this amount to the same time period, which results in no discounting at all. So that is the reason why the discounting factor will be 1. Okay, now we can easily figure out its present values for each of the years by multiplying the net value with our discount factor. For year 0, that's negative 480,000 times 1, which results in negative 480,000. For year 1, that's 170,000 times 0.909, which results in the value of 154,530. For year 2, that's 170,000 times 0.826, which results in the value of 140,420. For year 3, that's 190,000 times 0.751, which results in the value of 142,690. And for year 4, that's 50,000 times 0.683, which results in the value of 34,150. Now, by adding these present values, we figure out the total net present value, right? That's the sum of these 5 amounts, minus 480,000 plus 154,530 plus 140,420 plus 142,690 plus 34,150, which results in the negative value of 8,210. All right, this concludes our net present value. Now we can move towards the third one. Now we need to figure out our internal rate of return. Okay, this is quite tricky. The formula for internal rate of return is going to be the lower discounting rate plus the higher discounting rate minus the lower discounting rate divided by the NPV at lower discount rate minus the NPV at higher discount rate times our net present value at the lower discount rate. So remember above we were given two discount factors at 10% and 7%, and in this case our higher discount rate is going to be the 10% one and our lower discount rate is going to be 7%, right? So the lower discount rate is 7% plus our higher discount rate minus lower discount rate. So that's 10% minus 7%, right? And then we need to divide by the net present value at the lower discount rate, but we only figured out the net present value for 10% discount rate above, right? Which means we need to repeat the entire process and figure out the net present value for this particular rate of 7%. So I'm just going to figure that out right here. So that's net value of 480,000, which is negative, 170,000 positive, 170,000 positive, 190,000 positive, and 50,000. So now I just need to copy down the discount factor of 7%. Let's have a look above. That's 0.935, 0.873, 0.816, and 0.763. Let's write it down. That's 0.935, 0.873, 0.816, and 0.763. And for year 0, that's always going to be 1. Now we can figure out the present values by multiplying the net value with the discount factor. And for year 0, that's negative 480,000 times 1, which is also negative 480,000. For year 1, that's 170,000 times 0.935, which is also in the value of 158,950. For year 2, that's 170,000 times 0.873, which results in the value of 148,410. For year 3, that's 190,000 times 0.816, which results in the value of 155,040. And for year 4, that's 50,000 times 0.763, which results in the value of 38,150. Okay, now we just need to figure out its total. That will be the sum of these 5 amounts, negative 480,000 plus 158,950 plus 148,410 plus 155,040 plus 38,150, which results in the value of 20,550. So this is the net present value at the lower discount rate of 7%. Let's write it down. That's 20,550. And now we need to subtract the net present value at the higher discount rate, which we figured out above. And this has a negative value of 8,210. And we're already subtracting it. So that's a double negative sign, which results in a plus, right? So we are going to add the value of 8,210. And now we need to multiply it with the NPV at lower discount rate, which is 20,550. Now this gives our internal rate of return to be 7 plus 10 minus 7 divided by 20,550 plus 8,210 times 20,550, which results in the value of 9.14. And this should be in a percentage. Okay, now this concludes the first part of this question. We can now move towards the second one. Advise the directors whether or not they should buy the machine. Justify your answer by referencing to the calculations in part A. Okay, so the first thing that we figured out was payback period, and we know that the machine has a useful life of 4 years. So the machine can only be used for 4 years, right? And we figured out that our payback period is 2 years, 9 months. So let's figure out the difference between the total life and this payback period. So that's 4 years, 0 months minus 2 years, 9 months, right? Now, if you take out 1 year, that's going to be 12 months. So that's 12 minus 9 months, which is also in 3 months. And that's 3. So the year is 3 minus 2, which is 1. So what we can say is that the payback period is 1 year and 3 months before the useful life, which is 4 years. Let's write it down. Payback period is 1 year and 3 months before the useful life of 4 years. Now let's refer to our net present value. Okay, and we actually figured out the net present value to have a negative amount, right? Let's write it down. It has negative net present value. And the last one is our internal rate of return. And internal rate of return should always be compared with our cost of capital. And in this case, the cost of capital was 10%. An internal rate of return higher than the cost of capital suggests that it is a good investment, but if it is lower than our cost of capital, it suggests that it is a bad investment. And in this case, we can clearly see that it is lower than our cost of capital, which means that the investment to buy the machine is not a good one, So I'm just going to write it down. Internal rate of return is less than the cost of capital. So in this case, our payback period is less than the useful life, which shows that it is a good investment, right? But we have negative net present value, which is a bad indicator. And internal rate of return is less than the cost of capital, which is again a bad indicator. So the bad outweighs the good parts, due to which I am going to suggest the directors not to buy the machine. Let's write it down. The directors should not buy the machine. All right, this concludes the second part of this question. We can now move towards the third one. We are given additional information. The cost of the machine, 480,000, includes the purchase price plus 20% tariff or import duty on the purchase price, and due to the recent trade agreement, it is highly probable that 20% tariff will be abolished, which means that we will not have to pay the import duty of 20%. And on the basis that the tariff is to be abolished, the directors have recalculated the payback period and net present value and decided to buy the machine. Now, for the third part, we need to comment on the director's decision to buy the machine when the tariff is abolished, and we need to support our answer with relevant calculations. First of all, let's figure out the tariff price, right? We know that cost plus tariff results in the price of 480,000. And we also know that tariff is 20% of the purchase price, right? Which in this case, I've written it down as the cost. So I can write it down as purchase plus 20% of purchase, which is 0.20 times P, and that's 480,000. Now, if we take P common, that's going to be 1.20 times P, which is also in the value of 480,000. Now we can easily figure out our purchase price, which is 480,000 divided by 1.20, which results in the value of 400,000. Okay, this just means that the tariff is the difference between 480,000 and 400,000, which results in the value of 80,000. Now we no longer have to pay 80,000. So from the initial investment, we could deduct the 80,000, right? Let's have a look above. Okay, let's calculate the net present value. So previously our initial investment was 480,000. Now it could just be 400,000, right? So 400,000 times 1 is 400,000. But the other remaining years will remain the same. So now the new net present value could be the sum of these 5 amounts. So that's negative 400,000 plus 154,530 plus 140,420 plus 142,690 plus 34,150, which results in the new net present value to have the value of 71,790. Let's write it down. So revised net present value is 71,790. Now let's calculate the revised payback period as well. And previously it was 2 years 9 months. So the amount that we require now is 400,000. That is the cost or our initial investment, and 400,000 is definitely in between these two values, which means that our payback period is still going to be 2 years and some months, right? So I'm going to write it here. That's 2 years plus, and that is just the difference between the amount that we actually require and the amount that we have already gotten, which is 340,000, right? So that's 400,000 minus 340,000, which results in the value of 60,000. So 60,000 is the return that we require in those months, right? And that is out of the total return of 190,000 for that particular year. So that's 60,000 divided by 190,000, and we need to multiply it by 12 in order to figure it out in months. And this gives us 2 years, and 60,000 divided by 190,000 times 12, which results in 3.79 months. We can round it off, so that's 2 years and 4 months. Let's write it down. That's the revised payback period. So revised payback period is 2 years and 4 months. Okay, now we need to comment whether the director's decision to buy the machine is correct or not. We can clearly see that the revised profit has increased a lot and the revised payback period has obviously decreased, which means that our initial investment will be returned in a shorter period of time. So I'd say that the director's decision was correct. Let's write it down. The director's decision to buy the machine when the tariff is abolished is correct because there is a positive net present value and a shorter payback period. Alright, this concludes the third part of this question. We can now move towards the fourth one. We now need to explain why the directors of W Limited use the payback period and net present value to make their investment decisions. So let's talk about net present value. Net present value definitely considers the time value of money as it incorporates the discount factors, right? So it considers the time value of money and net present value also considers the whole life of the asset. Since we calculated the present value for each of the year above, considers the whole life of asset. Now let's talk about payback period. Payback period is quite easy to calculate and understand. And payback period is essential in order to know when the investment can be recouped, right? So need to know when the investment can be recouped. Alright, this concludes the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.